Welcome, everyone. We are ready to get started on today's webinar. I'm Allison LaForgia, the Senior Webinar and Events Manager at HousingWire. And today our topic is how lenders can recession-proof their business. And today's webinar is brought to us by Qualia. A few housekeeping items before we get started with today's webinar. We will be having a Q&A session towards the end of the webinar. You can submit questions for Sarah or Charlotte at any time by clicking on the Q&A icon at the bottom of your screen. Also, we will be using a PowerPoint in today's presentation. We will be sending a copy of the PowerPoint out afterwards, and there will be some resources mentioned during today's discussion. If you would like access to those resources, you can request them in the chat or by using the Q&A icon, and we will be able to send those out to you afterwards once the video is ready. As I just mentioned, this webinar will be recorded. We will be posting the recording on housingwire.com under the webinars tab, but we will also be sending a copy out to all registrants. So if there's anything that you miss, you'll be able to watch this or send it to other people to view on demand. Now, with that, I'm going to pass everything over to Sarah to get started with today's content. Sarah, the floor is yours.
Thanks, Allison. I'm really excited about this. I'm Sarah Wheeler, Editor-in-Chief at HW Media, and I'm here with Charlotte Brown, who's the Senior Director of Product at Qualia, for this really timely webinar. I seriously cannot think of a more timely topic. Charlotte, welcome.
Thank you so much.
It's great to have you. We've got so much to talk about, so let's jump in there. Like I said, the topic is how can lenders recession-proof their business? And, we are right in there. So we're going to talk first about, are we in a recession? Where are we with housing? And then talk about some of the efficiencies and some of the things they can do. This includes, how lenders can ensure they're ready to take on any market challenges that may occur, because we really have some uncertain times. It's also how lenders can optimize their loan production lifecycle from application through post-closing to improve margins and boost profitability. So let's jump in and let's talk about where we are economically. Wow, over the last week, things have even changed very dramatically and rapidly in the global economy, in our national economy, and down to the housing level. So let's talk about the economy. Is the economy in a recession? And it really depends on how you want to define that, but it's hard to see how we don't go into a recession if we're not already there. The Federal Reserve Chairman Jerome Powell last week hosted a session where he was very clear about his mandate was to get inflation down, and that's going to require putting us into a recession, basically. We have our lead analyst, Logan Motoshami, has a 6 recession red flag model, and all of those recession red flags are up. Those include the unemployment rate, getting worse, the Federal Reserve starts to raise rates. Wow, have we done that? The inverted yield curve, an overheating economic sector, in this case, looking at the durable goods, and then looking at new home sales, housing starts, and permits, which all fall into a recession, as well as the leading economic index, the things on that decline 4 to 6 months going into a recession. So all those red flags are up. It really depends on how you want to define recession, but it's hard to see how we are not in that already or closely going to be there. So love to get your take on that as well.
Yeah, and I don't have too much to add. I mean, what we're seeing is definitely particular to the housing sector at Qualia is just, it's year over year, home sales are down, and we're starting to see affordability be impacted, which I think at the beginning when people started talking, is this a recession or not, that wasn't so much the case. And now with interest rates being what they are and unemployment starting to rise, affordability is becoming a much more kind of prescient part of the conversation.
I think rates are really the volatility here that we don't know. When we started talking about this webinar, even last week, we were saying, rates going from 3 to 6. Well, rates went to 7 yesterday, and we have seen a little bit of pullback this morning. Really hard to say where we're going to end up on that, but that sort of rapid change in rates, especially when this started happening in the spring, so especially May to June, June to July, and then now in September, has been really hard on the housing market, because it's not just that rates are rising, but the fact that they're rising off such historic lows, that's been tough.
Yeah, I think it was Logan who surfaced this pretty early on of just the rate of increase is what's so historic, because of how low they were at the beginning. Yeah.
And some of that is really, people then are looking at like if they are locked into those low rates, they really don't want to put their house for sale because then they're, the next house they buy is going to be at this much higher rate, right? And so what we're seeing is we're looking at, will we see a mortgage rate lockdown? We're not quite there yet. But what that refers to is like, listen, I'm locked into a 2 or a 3. Why would I put my house on the market and have to then go buy? And so we are seeing the result of that, which is really low inventory. We started off the year with low inventory. It has not gotten significantly better. And that's a problem.
Yeah, exactly. I mean, it's not just down, year over year. It's down many years back because of how, that real estate boom started back in 2019. I mean, maybe even before, you could kind of argue, but 2019, 2020 were already looking like pretty exciting years into 2021. And so it's made everything that's happening this year feel, that much more surprising. And again, yeah, there's just very little motivation for anyone to refinance for probably many years to come, based on the rates they're locked into. But we are, interestingly, we're still seeing some vehicles used. There's HELOCs and other vehicles that are still accessible to folks and lenders.
And I think those products are going to be key, and we'll definitely get into some of that. One of the other things when we look at inventory is we don't really see like home builders coming to our rescue here. That's not really going to be something that we can count on as far as like inventory. In fact, with rates rising that high, the builders are going to pause. We do have some, you can look at it and go, oh, there's all this in construction, but really historically it's still very low, not even 1 million. And actually homes that are for sale right now, new homes that the builders have built that are completed, it's down to like 49,000. That's crazy. That is a crazy low level. We reported on that yesterday, and it's just really not going to, it doesn't help us at all.
Yeah, that I think builders are in some of the toughest spots because I think in 2021 people were banging their door down, like begging for inventory, and then all of a sudden it's gone from like people groveling for more inventory to it just not making sense. But then they have such a long lead time as well. They have to make some bets on where they think the market will be in 6 to 12 months, and they're definitely in a difficult position.
Well, we've seen them having now to make concessions, which was not the case. I remember reporting on the Austin housing market in 2020, and towards the end of 2020 and beginning of 2021, the builders would have people camping out on their lots like before that. I mean, there wasn't a house built. It wasn't like they were lining up for a showing. They were camping out on the lots to try to buy the lots. Like, wow, what a change,
Yeah,
not happening anymore.
it's incredible.
And with everything that's happening on the housing side, then you really see like affordability is really taking a hit. So, median price for a single family home is over $400,000. And with rising interest rates and rising home prices, because we haven't really seen home prices drop the way you would think when you have those rising interest rates. So far, they are slowing. The rate of growth of home prices is slowing. That's not to say they're going down. I mean, that it's not growing. So we're still seeing prices rising, hasn't really reset yet. In local markets, people are able to, hopefully if you price it right, it'll sell right. But we haven't seen a big, drop there. And so now you have that double whammy of now I've got 6% at least interest rates, and the homes haven't really dropped. So I think that the housing sector is really in trouble right now.
Yeah. Yeah, it's a little soul searching going on. I hope we can share some ways to guide through today, because I think it can be an opportunity based on how you look at it, but there's no doubt it's a tough time for the market.
Well, let's talk about that. Let's get to it. What can lenders do to come out ahead? Because this is why I'm excited about the timeliness of this topic is that, I mean, this is the time. It's tough to make money right now. It's tough to, we have really low volume. So let's get into that a little bit.
Yeah, I mean, if we look at how lenders were thinking about their businesses the last 2 years, I mean, it was volume, 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 and so they were not really spending a lot of time looking at their margins because all the profitability was in the volume, and that meant that lenders chose some really fast ways to solve problems that were probably quite expensive actually, or not the most efficient, because they just didn't have time to sit down and think through how to properly solve each problem in a future-proof way. They were kind of like, I need a butt in a seat and this needs to keep moving. And so I think there's a really great need for efficiency because now we have actually lenders who have very expensive processes that they were forced into in high volume markets, but no volume. And so their margins are actually looking kind of worse than ever. And so now is a really good time to look at the margins and look at your operations and really look at, what is it, how is my loan process from beginning to end? How are borrowers coming in the door? Once they're in the door, what's every touch point with my teams? How are they handing off? And start really mapping out, what do my systems look like? Where are we losing time, losing money? What are some opportunities to do this more efficiently?
And what do you see like, I mean, do you feel like that's all internal? Is that some of the ways that they're working externally? Like, what does that look like to really optimize?
Yeah, I think the biggest opportunities are probably going to be internal in terms of standardizing their own processes. But I think something that's happened during also this kind of great bull market that we were in, real estate was in a great place, but also so was the technology sector. There's a lot of new tools on the market. Silicon Valley really made a big pivot into legacy industries in the last 10 years. I mean, healthcare is really benefiting from it. Even, government tech and real estate is another great example where there's lots and lots of investment that's been made. And so I think, if it's been 5 to 10 years since lenders have really looked at their tech stack, they might find that there's some really affordable and powerful options for improving their businesses.
I think we saw this before, after the Great Recession. Actually, a lot of the ways that lenders were forced to do something was by regulation. I mean, they were not going to be able to meet the new regulatory requirements without really investing in some of the technology that would let, for instance, a regulator monitor things from afar, kind of get into your records as opposed to like, here, I'm going to come on site and dig through your paper records. And I think that we saw a lot of things happen after that really laid the groundwork for what came after that in technology.
Yeah, that's true. I think there was a focus on the interoperability and kind of data standards, and Fannie Mae brought out some really powerful tools, the desktop underwriter and collateral underwriter, that really benefited lenders staying compliant. I think another really big area of investment in the last 10 years to remain competitive is really like the POSs and that borrower experience. Borrowers are able to find loans online. They're able to go through a full application process from at home. That's a big shift the market, did in the last 10-ish years that has gone really, really well. I mean, I think the lending institutions and technologists that have done that should feel really proud of doing that transition because it wasn't easy. But we haven't seen that same level of investment in internal operations. And I think, if we look at some examples like maybe kind of automated underwriting or something like that, where people have been talking about that for probably decades now, since the early 2000s. That's still not widely used, but the technology to at least make a lot of progress there, if not do it completely, is available.
I think it's really interesting because I think the potential now is so great. So as opposed to like, we've really got to just focus, the lenders focusing on like, just to be compliant, we have to do this. Now it can really get into the kind of things that can make a difference to the bottom line. And I think
Totally.
right now, as you said, the last couple of years drinking from a fire hose, that wasn't what they could do. But now, they can. So let's get into some of that and what you think is going to be most important.
Yeah, I think you know, margins have not been great, but they don't have to stay that way. I think there actually is a lot of room for improvement. And so I think when looking at kind of how expensive the process is, often labor is the highest expense. And so it's kind of looking at those really labor intensive parts of the process and seeing what tools you can give those folks. I think also for a lot of companies where they're having to reduce staff, the staff that's around are extremely high skilled, and you want to make sure that you're able to leverage them to the biggest capacity and that they don't end up doing a bunch of rote tasks. And so I think there's ways to put tools, in the right people's hands to both, make sure they're not doing highly repetitive tasks, make sure they have time to solve the problems that only they can solve. And also hopefully increase their satisfaction and then keep them happy in what's, a pretty choppy market. And so, yeah, I think a lot of that has to do with, you'll probably hear me say this a lot, it's the transitions, where in your process the loan file changes hands. That is a really good area to look at because that's usually where a lot of time is lost. That's usually where mistakes are introduced. If you're looking at why you might have taken a loss on something, it's probably, and you're going backwards engineering, it probably the mistake was introduced at one of those times. And so that's a really good area to look at for your processes.
I can imagine too that that's the part that really you don't think about necessarily. Like if you segment those out, like, okay, this part of the process, this part of the process, but the transition between the two and how and the opportunity there to drop the ball or to get back into a manual position in between two automated processes seems high.
Yeah, exactly. I mean, I think it's that's another way to kind of encourage people to think is you want to give each team the ability to do what they need to do to the best capacity and error-proof their work and make their work more efficient, but also look at the connection between the two. Because what we found in some research we did is that loan officers spend maybe 20% of their time trying to figure out where the loan processors are at with their tasks. So if you don't have some way to give them transparency into the rest of the process, even if you made their job really efficient, but you didn't make everyone else's, they're still losing time. And you really want to make sure they can spend all their time nurturing relationships. And so, I think it's the transparency piece is another really important part to up-level the whole system to work together.
Well, and 20% is a lot of time. I mean, that could be used doing a lot of other things besides just getting things from A to B to C to D, right?
Oh, absolutely. Yeah, it's actually quite shocking. We'll get into some other numbers later, but the amount of time folks are spending just asking the question, like, did that happen? Or where are we at? That question is, and it's happening in every part. Everyone has the same question. And so making sure the systems kind of work together is very, very important, the interoperability.
When we talk about people, I feel like, everyone says, oh, this is a cyclical business, which it absolutely is, right? We know that. But I don't think that with the capabilities that we have today, you would hope that technology could take some of the staffing up, scaling up and then laying off people out of the equation, because we have seen, people having to right size their business this year, and understandably, right, they have to adjust to where the volume is. But unfortunately, because they had to staff up so much, just as you said, throwing bodies at the problem in the midst of just huge volume, then the hangover of that is then you have to lay off. And so you would hope that as this time, as opposed to say 2008, right, as opposed to in the past, like this time, if we're investing in the right things, if lenders are investing in the right things, doing it the right way, there would be less of that painful scaling.
Yeah, absolutely. There's an interesting Harvard Business Review paper on this, which is, the ability to which companies can use this time to get better and improve their internal systems. There will be winners coming out because it is cyclical, it will come back, and that is ground that someone has to win. And so, if you're just planning to keep doing things the way we have been doing them, you're not setting yourself up for success when it does come back. So I think that's really a definitely important thing to internalize. And I think the opportunity might be even bigger because we're seeing some of the really big lenders, Wells Fargo's taking a bit of a step back. So there's actually, I think there's even more room to gain when the market does bounce back.
Absolutely. Just like last time after the great financial crisis, we saw really all of the depositories take a step back on mortgage lending, and that's really what led to the IMBs coming into their own on this. And so it'll be different this time, right? Every cycle is different, and we're not facing anything like the great financial crisis. I don't mean to say that. This is a totally different economic environment, but it is a difficult time for lenders, right? And to your point, this is the kind of environment, the kind of market that makes winners and losers. I mean, that you will see people gain through this.
Yeah, absolutely. And the other thing on the labor, and we've seen this a lot on the title side, and I think to a slightly lesser but still present extent on the lending side, is that fewer folks are choosing to have their careers in real estate in the millennial and Gen Z generations. And so I think, just kind of believing that there's this endless bank of bodies that will, willingly take these jobs or be interested, or, that might not be true going forward. And so I think it's just another good motivation to, really think about how to future-proof, get technology in place so you really aren't relying on the idea of just, adding bodies as the way to get through the next upswing.
I think that's a great point. Well, let's talk about, why should lenders invest in operations now specifically? It is a time when they might feel like, well, I don't really want to be spending that money right now, but, why does it make sense?
Yeah, I mean, we've talked about a lot of the themes already around just starting to take a harder look at the margins and improve those, and just the role technology can play in that. But the other thing we talked about is those handoffs and the transparency between teams. And I think all of that, when you look at it from a technology lens, the solution to a lot of that is going to be integrations, is probably some new technology stacks, and then some integration of existing technology stacks. And integrations are, they're absolutely necessary to start to reduce the dead time in the transaction. If you look at how long closings take, there are these periods of just waiting where actually no activity is happening from any party. And it's, it's gone from someone did their job, now it's gone and sit in someone else's queues. And so I think when we come out of this, the expectations from borrowers are going to be, I want to close on my phone, I want to close fast. They're going to be a little bit less tolerant of long wait times, in-person closings, those kinds of things. So there's definitely some really key pillars of making sure as much as possible is digital and online, making sure you're integrated so you get rid of those dead periods. So as soon as someone has done their job, the next person can do, it's queued up for the next person to do their part of it. And that requires integration. And integrations themselves, they take a little bit of time to set up. Often they're not the type of technology that you snap your finger and it's on often. And so it's worth thinking, okay, I'm gonna invest in this now, take the time to set it up properly, which might take 3 months or so, and then just put yourself in a really good position into the future.
I really like that idea. Integrations can be, I think they really scare a lot of people, right? It's just like, the time they're going to take, the effort they're going to take. But I also think, to your point, if people are looking back even a couple of years at how long integrations took or what the pain was, things have gotten better than that, depending on what they're looking at. So what would you say to that if someone's like, integration, they're just dreading it?
Yeah, I would say they've definitely gotten better. I think technology companies, I can think of a lot in the mortgage space that they've found ways to make integrations like out of the box in a new way. So you don't have to rebuild every single time with each partner. I think there are now platforms available that can allow you to integrate with many people through like one integration and things like that. So I think there's definitely some good options on the market. The technology itself is better. And I think also for a lot of folks, they forget, like maybe now that their POSs are in place, they forget that there was some integration period or onboarding time or some change in configuration in their LOS that they had to do, because once the wheels are turning and there's that momentum, it all feels easy and you adjust and you've gone through the change management and you forget that there was even that effort to begin with. And so that'll be the same here. There'll be a little bit of work, but people mostly have the time to do that work. And then they'll really forget that they ever did it in the end. There's definitely an ROI on setting up some of this technology.
I love that idea. I also think that, you mentioned borrower expectations. We're in a purchase market, and people are we've been trained by Amazon and other things to really expect great customer service, a seamless process, much more. So to me that says digital mortgage. So let's get into some of what that looks like specifically.
Yeah, absolutely. So I think where the mortgage industry has done extremely well is in that front end of the transaction. I think when a borrower goes through a digital mortgage, they have increased satisfaction, as you can see here. It does move faster when it's moving online and not sitting on someone's desk, as it turns out. And the transparency piece is quite high. Borrowers feeling like they understand what's going on, and then that gives them a better experience. And then for loan officers themselves, they're doing less paper pushing. I think the role of the loan officer is evolving in a similar way as what the real estate agent went through with the rise of Zillow and all these listing solutions that entered the market. There was a big fear that, oh no, agents are losing their jobs. But actually, real estate agents are used at a higher rate than ever. And what they do has changed. And so they don't have to do just the listing and finding properties. They're doing more of the coaching and the consulting, and people feel, I think the loan officer will have a similar change. It's like, yeah, the application's online, but the borrower still wants to talk about this in the context of their greater financial portfolio and things like that, which a loan officer definitely can do. So I think folks shouldn't feel scared of digitization. Their consumers will be happy with the experience. They will still be needed. I do not think like the human touch of real estate is going away anytime soon. And so so I think the front end of the transaction's gone really well. And then what we see happen typically is as the transaction goes into closing, the borrower experience starts to decline a little bit. More parties get involved. It gets a little bit more confusing what's happening. So the transparency tends to go down. And yeah, we can talk a little bit more about that. But I think the investment in the middle is definitely needed right now.
To your point too, in a volatile rate environment, your loan officer is invaluable. I mean, you need to understand how this affects you, if you should, like when you lock and should you wait, and is there any way that they can help you with, MI, or like, how are they helping that person as these things change rapidly? So having this part automated, having some automated and freeing the lender up to really be the trusted advisor, to me is a much more, is a better use of their time.
Absolutely. And I think it's realistic to expect anyone who is buying right now and, getting a loan, they'll probably want to refinance. And
Yeah.
if they have that good relationship, who are they going to call when it's time to do that? So I think it's definitely an investment right now in that continued business with the borrower.
I think that's a great point that, that is the upside, if there is one, of higher rates, is that we hope that at some point in the very near future, then you will have candidates for refis.
Yeah, exactly.
So let's talk about what we know about these benefits from investing in operations, and that there's a window of opportunity for investing that for those that do reap the benefits.
Yeah. Yeah, and I think it's interesting because we've talked a lot so far about that front end being fairly, tech savvy, and there's been a lot of investment there. And I think what's interesting here is we still have a lot of borrowers who are abandoning their applications. There's something like 31% of the time, it's like 1 in 3 borrowers are abandoning their applications. They aren't able to do it in one sitting. So even if they are able to do it online, about just less than half the time, they're doing it over multiple sessions. And for a loan officer, you might not have visibility into the thought process there, or like why they left and came back. And so I think, there is still probably room for improvement of really turbo taxing that application, making it as smooth as possible, because people have very low tolerance nowadays for any resistance. So the minute it gets a little hard or the loading screen happens or whatever, something else is going to compete for their attention. And so, just making sure with the technology that you're investing, you're really aware of how it's being used, the experience of the borrowers. It's important to kind of know where you're losing folks, and what you can do to just finesse that even more.
It's so crazy because I feel like applications is one of the areas that has had the most investment, and we've really focused on that because it's a borrower touch point, a really important one.
Yeah.
And yet, you see the challenges that are still here. I mean, I got distracted 21%. I didn't, and we all know that. It's like, especially if it takes a long time to get through, if it's really hard, if you have to upload documents that you don't know where they are, it's not with all of the technology, it's still not maybe as seamless as we would like. And on the borrower side, this is but this is still has a lot of opportunities, which is interesting to me because I feel like so much of the technology has been thrown at this part of the process.
It's true. I think what's interesting is lenders could probably be using technology beyond just the application to get information about the borrower. I mean, nowadays you can create quite sophisticated profiles of folks from, just data that exists on them. And so, I think thinking through that, or and having the underwriting team really think about, how do they model the quality of this borrower, actually would be a really good area of investment, because then you can require less and less from the borrower themselves self-reporting some of this, and they'll have an easier experience. So I think that'd be an interesting area of opportunity.
I think it's interesting that nearly half of the borrowers surveyed, they were able to get through the online mortgage application process in one sitting. So I mean, that's good. That's huge progress.
That's fantastic. Yeah. And yeah, it's something like 70% of loans are going through that. I think that means a very high portion of all borrowers are applying online 100%, and that's a big achievement.
Yeah, I think the other area that we've seen, there's a couple other areas, underwriting and appraisals have also been a focus of technology, and where we can cut out some of the inefficiencies. Walk us through that.
Yeah, absolutely. I think appraisals have been a really commonly reported pain point from lenders of it's just very hard to secure an appraisal in a timely fashion. I think 4 in 10 loans experience slowdown around the time of getting the appraisal. And I think appraisals are still quoted on a case-by-case basis. And so that, when you look at the scale, is just like there's a massive inefficiency there. And so there's, it would probably help to put more technology in the hand of the appraisers to think through how they're doing their quoting, which would then benefit the lending institutions as well. Hopefully, it should benefit both sides. But yeah, that's been a very common pain point that we've seen. And yeah, I think here we see that 23% of appraisal related time is actually spent on following up. So it comes back to that question that we talked about before, which is like, where are we at? And so when you have, all this time spent just trying to figure out what's going on, to me, that's always an area where it's like, technology should probably be able to help here, and integration, especially with AMCs in this scenario, something like that.
No, I think, and especially again, this is one of the touch points with the borrower that causes them the most anxiety. Is it going to, what is it going to appraise for? What am I going to be approved for? And I think it's still a black box in so many ways, and there's a lack of transparency. If you're the borrower, you're like, well, where are we? Oh, we've ordered the appraisal. Has it gone out? How long is that going to take? How long is it going to take for the appraiser to get it back to you? How do I know? And so it feels like, this part of the process is resistant to some change.
Yeah. And I think it's, I think often when you see resistance to change, there's something behind that. And I think it's like the work that the appraiser is doing is, it's highly specified, specialist work. And there is a shortage of appraisers in the market. And so it's about, okay, how do you increase the capacity of these highly specialized resources? And so I'll be interested to see what investments lenders can make at this time to really kind of make themselves more robust to that upswing, especially in 2020 and 2021. I mean, I think appraisals got a bad name, maybe. I don't know if that's the right way to put it, but there was a lot of frustration about just getting that part of the transaction complete. And the appraisers were just, they're back to back to back. I mean, they were super incredibly busy.
I do think, if you look at this, 4 in 10 loans are impacted by extended turn time quotes by the appraiser, or the inability of a lender to find an appraiser to accept an order. And so right now what we see is that, yes, you have less volume. So you think that would make this easier. But I was at an appraisal conference not too long ago, and one of the pain points they were talking about is that with the volume coming down and more appraisers, then there is more question about what should be paid for an appraisal. And that particular point means that you might have to shop that fee around if an appraiser feels like, I'm not willing to come down to that level. And so again, you still have the inefficiency of like trying to match up the, what they want to pay for the appraisal, what the appraiser wants to get for that work. And, again, it's a pretty long process.
Yeah. And this might not be quite as true as appraisals, but I think it's true when lenders are looking at vendor selection at large. It's very common in mortgage in general to choose your vendors and kind of set it and forget it. And so much has changed, and so many, folks have entered the market, and pricing dynamics probably have shifted since a lot of folks have shopped for their vendors. And we have definitely seen this on the title side. I think companies are just unaware of how much more competitive of a rate they can get, or how much better service or more robust product they can get from newer vendors or just different vendors, or looking for vendors specialized in a certain region. And so I think this is a really great time for folks to look at, what are all my vendor agreements? Like, is this the best option in each of these verticals?
Really great point. To your point, I mean, when you're drinking out of the fire hose, it's not the time to be like, hey, let's put some people on looking at our vendor agreements like that. Yeah. I imagine that falls down to the bottom of the to-do list, but yet super important, right? It could be what's taking some of your margins if you're not being really efficient there.
Yeah, and maybe seeing like, oh, actually, we have really good results with this vendor. How do we get more of our business with this vendor? I think that's another big insight is like, oh, actually, this is working really well, but we're only using it, 60% of the time. So kind of going into this process of investment, I really encourage companies to really model out their whole process from beginning to end, what technology they're using at each point, what staff, what are their agreements, and really kind of scrutinize each of those areas of opportunity.
I think one of the things that can be so frustrating is the manual part that comes in. So say you're going along fine, you have this, this part and you don't know, then you've got to get on a phone call. Well, then how are you documenting what was found on that phone call? So you not only just have a manual intrusion into the process, but then how you document whatever happened to that manual intrusion is maybe another manual intrusion, or maybe people don't know. And then I feel like that was one of the things that was brought up at the appraisal conference, is that there was so much of this that like it's not a streamlined, this is how it always goes. And so I think that would be, again, back to your handoffs, back to your transfers.
Yeah, yeah, it's like the handoffs, transfers, and the transparency. I think we'll definitely, as we get into talking about title, which I think there's a lot of parallels between appraisal and title, but the statement, oh, I can't tell you how often I'm looking for something that's in my processor's email. It's kind of these updates and contexts live in people's head, they live in people's inbox, and they do not live in commonly accessible places or the existing systems of records that are already there. And so finding ways to make sure teams have, a standard, this is where you write notes, or if you're using integrations, a lot of that should be more visible to the whole team, whoever's working the loan. But it's a very crucial point. I think the proliferation of phone calls and emails often has to do with updating someone else about something that someone else already got an update on.
Right. I think the other thing that when you think about the fact that we have had so much downsizing, layoffs, so you have holes maybe in your process that you're not even aware of, or you didn't know, oh, this lived in this person's head, or the fact that you might have some people who are covering for other people who don't typically do that. Now you're left with some of your best and brightest, and that's great, but boy, you hate to have them be focused on some of those things, and then scrambling to figure out what the people who got laid off, what they're doing.
Yeah, absolutely. Yeah, picking up a lot of kind of loans mid-process and being like, okay, what's happened so far? Yeah,
Well, let's
absolutely.
talk about let's talk about title and where we can, what the inefficiencies and closings, including
Yeah.
are, and what some of the things that we can do to fix that.
Yeah, I mean, title is just such a big area of opportunity because it's the title and settlement process, that's the bulk of time that a closing for, a loan closing is in this process. And there's massive amount of interdependency between the lending team and the closing team, the title or settlement team. And so we ran a survey with Stratmore Group earlier this year and found some really interesting outcomes from that, which was, 1 in 4 lenders are spending 75% of their time on any loan. It's like 75% of the time communicating with title, trying to figure things out with title. Like if you're looking for, oh, like what's a number we should get down? It's like, it's that one. That's a big glaring one. We see that on average, there's more than 30 emails per loan. And emails is, it's very quick and easy and tempting to communicate that way, but it's very unstructured. It's very susceptible to phishing, fraud right now. It's really compromising folks' data. And in the end, it results in a lot of rekeying on both sides because email is not where either team is living. Both teams are living in their systems of record. That's a LOS, or title companies use TPS as title production software. So then both teams have to leave, pull data. And again, like we said earlier, where there's errors is usually in those handoffs or moving data from one thing to another. If that's happening manually, it's only human to make a mistake. Some percentage of the time, it's almost a guarantee there'll be a mistake.
Well, and then just to think about, on email 17, to your point, the security, intrusions that could happen, that you as the borrower, you're like, oh, well, I'm down to, I'm on email 17. Surely this is the same person I've been talking to. But just think about the vulnerabilities that every single time you have that email, it really opens you up to, and would be hard to figure out.
Oh, absolutely. And I think you see like more and more people get added to the thread.
Yep.
And then a lot of times these threads will go back and forth between a lending team and a title and closing team. And then maybe someone adds the borrower at some point, and then they're kind of horrified. They're like, whoa, what is this? Is it okay? Like my social security number's there or something, we definitely hear a lot of stories about when the borrowers get a peek behind that curtain, it doesn't look so good. Even though when you're working in it, you're in the flow and you're doing what needs to be done, but that's not the view the borrower's used to.
Absolutely not. Oh my gosh, let's look at this chart and some of the contributors to inefficiencies.
Yeah, I think the poor communication and responsiveness is just a really, really high area of like people across the board just feel like, that's the biggest problem is I don't know what's going on, or I'm not getting the news I need fast enough. And I think, lack of visibility and poor communication to me are really kind of tied, but a lot of people just feel like they're not getting the service they want, basically. And the lack of organization as well is a big factor of just not feeling confident in the vendor's workflow, basically, and just not knowing for sure that they're doing the thing that most needs to get done right now. So I think that those are some of the areas that jumped out to us. And then the other thing that's really interesting that I don't think's captured here, but a quarter of lenders are working with more than 100 title companies every month.
Wow, that is crazy.
Yeah. And now we're in a purchase market. That's much more true than it was in 2021. You're not getting to choose your partner. And so the lack of organization gets very exacerbated. And then if you think about that 30 email thread, times 100 times they have a team of 3, just the number of emails and names you're trying to keep straight gets very, very high very quickly. And it's kind of an impossible task for anyone to manage, by themselves. And so so I think it's when I look at this as kind of a technologist, so to speak, like, okay, the process that both teams are going through is quite predictable. Like lending teams know how they want the loan to go from approved application to closing. The underwriting team knows exactly what they need to get to be able to approve that loan to go to and clear it for closing. The same is true on the title side. They know exactly, what documentation they need to produce to have a compliant closing in that county and where it needs to be recorded. They have their workflows down. And those workflows are predictable, and therefore it should be really easy for both sides to just see where they're at. It's like, okay, it's this type of transaction in this area, let's just like flow. I'm going to send you all of the information you need through an integration. As you complete your tasks, you're going to send that back immediately. We're not going to wait until everything gets done, aggregated into an email. In the meantime, receive 6 phone calls. Like, is that coming? Like, oh yeah, it is coming. So I think making sure that both systems are able to, keep the other party that's dependent up to date as things progress, and give that shared view of, yes, it's progressing as we expected, would do wonders for these dynamics where that kind of solves the communication, the responsiveness, the visibility, and the organization, because all anyone wants to really feel is, we're on track to close.
So what does that look like if I'm a lender, right? And I have all of these different title companies I'm working with, so I can adopt software, but how does that affect how I deal with all of these different companies?
Yeah, I think there are options. I mean, Qualia Connect is one of them, and then there's others in the market that they're able to set what the workflow that they want is, what they need from their title companies. They need a commitment, a CPL, and a preliminary set of fees by this state. And they can set standards uniformly and communicate those through the integration to all the title companies so that when the order is placed with the title company, it just says, hey, I need XYZ thing, I need it by this date. And title company is like, great, I'm on it, and then give the title companies a way to deliver that back to you through the integration so that it's not sitting in your processor's email waiting for your processor to upload it. It just goes directly back into your LOS. And so there are lots of options for that type of integration. And I think, it's this is the bulk of time your loans are spending in process. This is really good area to think through what technology am I leveraging.
No, great question. Great answer there. So we've had a couple of questions come through, and I wanted to ask you, and then you can decide if you want to, what part of this you want to do. But we had a question that says, how do you solve for appraisals in the market that don't adopt technology, especially when it comes to sharing availability? And I think that that is not just an appraisal question. I wonder if, if you're dealing with 100 title companies, what level of technology do they have to have and be comfortable with, so you as a lender, even if you have the technology, it works with them?
Yeah, I think, what we see, title companies, they really value their relationships with lenders. If lenders say, hey, I want you to work in this way from now on, typically title companies say, okay. They're like, okay, we'll do that. The lender is the customer of the title company. And I think the title, I think it's not visible to both sides of the market how much technology investment has happened. Technology companies are title companies are highly tech enabled. There are some really great integrations. And so I think it's okay for lenders to set this expectation with their partners, like this is how I want to work from now on. And these vendors will kind of adapt to that. And they have the ability to and the interest.
That's really good to know. I mean, that's not something that's obvious to me as sort of an outsider going, how technical are title companies. I went to a title company conference, met a ton of people, and was just struck by the fact that so much of the title industry, just like so much of the lending industry and other parts of this, are still very distributed. It's not, no one has overarching market share. You might have a company of two people, a company of, a family company, very common. And so I just wasn't sure what the level of technology you could expect there.
I know, it's interesting. I mean, what you'll see is most title companies are fully like off paper, they're fully digital. And the last thing, title companies, they'll go through ups and downs in the market. They'll cut staff before they cut the technology that they use as their system of record. It's very, very essential to their business. They're under, very high levels of scrutiny under auditing and things. So they just have to have some of this technology in place. And so they're always advertising their services to, lenders and agents. And so they want to keep up as well. So even though it is highly distributed, I think the distribution has a lot to do with the localization of real estate and the title part of the process being, the most entrenched in those local regulations. So if you give lenders and real estate agents and brokerages access to that diverse network of title companies who are actually really good at closing in their specific area, that's very powerful for the lenders. Because even when they're going to some of these really big, maybe national title companies, a lot of times those national title companies are turning around and asking for help from some of these local ones. And so, there's there's a lot of power in the distribution of that network. And so making sure the lenders can leverage that through their integrations is really important.
Just like we talked about the application and the appraisal part, this is another, this is the last touch point with the borrower that you get is closing. And so just the experience there is really going to, the recency bias is going to really stand out. You might forget, oh, what was the application like? By the time you get here, it's like, what is this last experience? So from your perspective, what is the impact that lenders can have by cutting out some of the inefficiencies at this part of the process?
Yeah, exactly. I think if lenders can confidently say, we're going to close on time, the closing's on track, I'm working with this great partner, you might have seen communication for them, or if the lender's managing the communication and can just instill that confidence, which they get from getting the visibility into the title process, that will really help the borrower quell the concerns that mount. And, if they're going into closing feeling happy, that's a very important part, because then they have to sit and sign, stuff,
right.
Which is hard on anyone. But yeah, you really want to think about your borrower's mentality going into closing. And so that's where that transparency is really important, and the predictability. And then the closing itself, I think now is a really great time for folks to look into their digital closing providers. Can they do that online? I think the seller side's a little easier than the borrower side for sure. And so I think but now's the moment to say, okay, how can I start to incorporate that? So my borrower's traveling or whatever, we can still close on time, and they'll feel kind of impressed, like, oh, I did it from my phone in Cabo or whatever it is.
I've actually done several remote closings starting in the pandemic. And it turned out great. I thought it was great. I also have had some very manual, like old school closings where it was like, we just killed a tree. We just did this with this,
Yeah. And then, sending a mobile notary who might not be as versed in real estate. There's always that risk if your borrower has a question, what happens? And so, remote closings can actually be a way to make sure you're there no matter where the closing is happening, and can ensure a good experience.
Well, we're coming to the end of our time, but I would love to give you, a last opportunity to talk to lenders about, why now is a good time and what you would tell them.
Yeah, my advice is model your process, make sure you have the visibility you need into your own business. I think if you find when you look internally, like, oh, I actually don't know where to look for these things, like, that's okay, but don't give up, like, keep pushing, be like, go the extra step to make sure you can have it modeled, because I think what you'll find is a lot of opportunities to improve your margins, reduce the amount of dead time in the transaction so that your handoffs are really clean, your transparency is high. And so one thing that I like to kind of suggest is think of yourself as a professional athlete, imagine that high volume scenario where you'll eventually be in again, and how you want your business to run and how you want the process to feel, and start working towards that now. I think there's a lot of really great technology vendors who can help you get there. A lot of them are quite cost effective, and the time spent here, you will not regret it. You definitely will not regret it.
I think thanks for doing this webinar, because I feel like this is a bright spot. It's a really challenging time for everyone in housing right now, including lenders. So great to be able to offer some solutions about, like, here are some things you can control. You may not be able to control volume, but you can control the efficiencies of your process, which have a direct line to your bottom line, to your ROI. So thank you so much for being on, Charlotte. I learned a lot, and I hope that our audience did as well.
Yeah, of course. Thank you for having me.
And unfortunately, we're out of time for today. You guys made it just in there right before the top of the hour, which is amazing. And Sarah, thank you so much. Charlotte, thank you so much for sharing all of these insights for our audience. To our audience, thank you for joining us today. We will be sending out the webinar recording to all registrants in the next week. You'll also be able to access the PowerPoint that was used today. So no worries there. You'll be able to see all of those slides and the data that was shared. The recording will also be on HousingWire's websites in the webinar page. Thank you for joining us today. Hopefully we'll see you all again soon.